Okay, hello everyone. I'm James Harte and welcome to this Orbex trader education session where we're going to be looking at some of the best technical indicators that you can use in your day trading. Now, many new traders begin their Forex journey with technical indicators, and the idea of using a tool to help you time market entries and catch powerful reversals is obviously an attractive one. However, with so many indicators out there, I understand that it can be quite daunting for new traders learning which one to use and how to use them. So in this session, what I'm going to do is run through a few of the indicators that I use for my own day trading and explain to you how I use them and how you can benefit from them in your own day trading. So we'll look at a few indicators in isolation, and then we'll also look at how you can combine some of these technical indicators to catch trading entries. So as ever, if you have any questions during the session, please just write them in the chat function and I'll stop periodically as I go along, and I'll also leave some time at the end. So let's kick off first of all then by looking at our first day trading indicator, which is the RSI indicator. So the RSI indicator is a classic technical indicator which is used to measure momentum in the market, and essentially the indicator is measuring the strength of recent gains against the strength, or the size rather, of recent losses. And what it does is it identifies momentum conditions as being either overbought and likely to reverse lower, or oversold and likely to reverse higher. And this can be a really great tool for helping traders identify periods when price is vulnerable to a reversal. Now, often this indicator works particularly well in range-bound choppy markets, but it's also really good for helping traders to enter on corrections during trends. So you can see the indicator here at the bottom. We have this blue oscillating line, and then we have our upper limit, which is the overbought limit rather. So when the indicator moves up to this level, this suggests that bullish momentum is overstretched and that price is likely to reverse lower. And then to the downside, you can see we have our lower limit. So when the indicator moves down to this level, this suggests that momentum is oversold and a reversal higher is likely. So it's a very straightforward indicator, and essentially we're just following this blue line as it oscillates between these two limits. So let's take a look then at how we can actually use the RSI indicator in our trading. Okay, so this chart gives a perfect example of how the RSI indicator can help you time the market. So what you can see here on the 1 hour chart, okay, which is often used in day trading, you can see here that we have the euro trending higher over the course of the day. We're moving higher, putting in higher highs and higher lows, and you can see that the indicator is also starting to move higher, putting in higher highs and higher lows. So this is all typical bullish trend action. However, you'll notice at this point here, I've highlighted a section, and if you look down to what's happening on the RSI indicator at this point, you can note that we have a really clear area of overbought rather, momentum. So the indicator has moved all the way up to the overbought region, and from this point you can see that price actually reverses lower. So this is the first and most basic way which we can use the RSI indicator in our day trading. Essentially tracking the indicator and waiting for periods when momentum is either overbought, where we look for bearish signals to sell, or looking for periods where the indicator is oversold and then looking for signals to buy. So in terms of how you'd actually go ahead and enter trades based on these signals, it really depends on the methods that you use, but some of the simple classic price action methods, such as waiting for bearish reversal candlesticks to form or waiting for a break of a bullish trend line, are all really simple, powerful ways that you can combine these readings with your own trading. So looking to trade reversals then, this is the first way which we can use the RSI indicator. And essentially all we're doing is waiting for periods when momentum is highlighted as being overbought and likely to reverse to the downside, or where momentum is highlighted as being oversold and likely to reverse to the top side. Now, another really fantastic way which we can use the RSI indicator in our day trading is to look to highlight divergence. Now, the term divergence essentially refers to a situation where the movement we are seeing in price isn't being supported by the movement in the indicator. And for those of you who have been in a few of these sessions, this is a term which I highlight a lot when we're talking about indicators. And it's really one of the best and most strategic ways to use indicators. And it can give you a really good early indication that a reversal is likely. So in this image then you can see a textbook example of bearish divergence. So again you can see that price is trading to the top side here. We get this really explosive initial move. Momentum stalls a bit, however you can see that the trend is still firmly to the upside as price continues to rise, putting in those higher highs and higher lows. However, if you look down to what's happening on the indicator as price is continuing to rise, you can see that we have that example of bearish divergence. So with price continuing to put in higher highs, we would expect that the indicator would also continue to put in higher highs, showing that bullish momentum is growing. However, what we can actually see here is the indicator starting to put in lower highs. So as price is continuing to rise, the indicator is actually starting to show that momentum is waning from the market. So in terms of price action always being a battle between buyers and sellers, you can see at this point that although the market is continuing to rise, buyers are starting to lose power. So the upside move is running out of steam, and this alerts us to the potential of a reversal lower. So waiting for divergence to occur is a really fantastic way to use this indicator because, as I said, it's a really great way of getting an early heads up on the potential for a reversal. So think about it, if you were looking at this chart without the indicator on, you'd simply see price trending higher and you'd expect that price would continue to rise. However, with the indicator on and being able to highlight this divergence, we know roughly from about this point here that although the market is continuing to rise, it's running out of steam, and this presents us with the opportunity to be on the lookout for a short trade. And again, the way that you can actually enter these trades really depends on your own personal trading preferences. But for me, I always like to stick to the simple things. So where we're using a technical indicator, I'll look for breaks of trend lines and I'll look for reversal candlesticks. Now, obviously, this is an example of bearish divergence. So what we're seeing here is the market continuing to rise while the indicator starts to put in lower highs, giving us a selling opportunity. So if this was bullish divergence, what we would see is the market moving lower and then the indicator starting to put in higher lows. And again, this would highlight us to the potential for a reversal, but this time it would offer us a buying opportunity. So this is the first indicator then that we can look at when we're thinking about day trading, the RSI indicator, a fantastic measurement of momentum, which offers us the opportunity to capture reversals based on overstretched momentum, but also based on divergence like we've seen here in this image. So let's move on to our next indicator then, which is the stochastics indicator. And again, like the RSI indicator, this is a momentum measurement which finds entry points where momentum is overstretched and price is vulnerable to reversal. So this indicator measures the relationship between price and the high and low of a range over a certain look back period. So again, it's identifying momentum as either overbought or oversold. And you can see here that just like with the RSI indicator, we have our upper limit, which signals momentum as being overbought and likely to reverse lower. And then we also have our lower limit, which signals momentum as being oversold and likely to reverse higher. Now, you might notice with the stochastics this time that we have two lines on the indicator. So we actually have two oscillating lines. So one of these is a shorter term, faster look back period, more sensitive to price. And then the other one is a longer term one. And I'll come on to how we can use those lines specifically just shortly. Okay, so let's take a look then at an example of how we can use this indicator to trade. So looking at this example then, you can see that price is moving higher and the indicator itself is moving higher. So this really highlights now one of the best ways why this indicator is so useful, rather, is because it can really help us to time our entries specifically. So where with the RSI indicator we only have one oscillating line, the way that we enter the market is normally to wait for the indicator to cross over one of its extreme thresholds and then cross back down below or above the threshold. However, with the stochastics indicator, we can actually be even more specific with our entry points, because what we can actually do is wait for a crossing of the lines. So the typical default settings for the stochastics are a 5-3-3 period. So what we can wait to happen is, I'll give you an example actually, this will be easier to talk through. So you can see here that price is trading to the top side. We have price continuing to put in higher highs and higher lows. So we've got a clear bullish trend in play. However, tracking the stochastics indicator, we can note that at this point here, the stochastics has moved into overbought territory. Now, one method which is particularly aggressive would be to sell price as soon as the indicator crosses into overbought territory. However, the issue with this is that price can still continue to run on higher despite the fact that the indicator has crossed into overbought territory. And so what we're always looking to do is find a way of refining our entry points to give us the best possible chance of getting a positive outcome. And so to that end, the best ways to use the stochastics indicator are to wait for a crossing of the line. So what we're waiting for is a crossing of the shorter term line, the blue line, above the slower line, the red line. So you can see I've highlighted here at this point where we get that crossing, and you'll notice just how specific the indicator is, because the crossing actually occurs at the very apex of this period of price action. So again, if we'd sold simply as the indicator registered overbought momentum, we would have been in roughly at this point here, and you can see that the market continued to run on higher beyond that point. However, if we wait for the indicator lines to cross, we actually get a really specific entry point, getting entry right at the very top of the move. So the stochastics is a really fantastic indicator, not just for highlighting overstretched momentum in the same way that the RSI indicator does, but actually for offering us a far superior method, or means rather, of timing our entry to the market. So this is one way that we can use the stochastics to be really specific with our entry points. Now the other ways of using the indicator are pretty much the same as we looked at with the RSI, so I won't go into those. You can again wait for the overstretched momentum to trade reversals, or you can wait for periods of divergence. But what I really wanted to show you with the stochastics indicator is the opportunity it offers for timing the market in a much more specific manner. So when you're using the stochastics indicator for your day trading, especially where you're using these momentum reversals, waiting for the indicator to move into overstretched territory, then the best way to enter really is to wait for these lines to cross over, because what you will tend to find is that these give the most specific entry points. Okay, so the next indicator then that we can look at is the MACD, and this is one of my personal favorite indicators. So the MACD, the moving average convergence divergence indicator, which sounds like some sort of far-fetched 80s invention, actually isn't. It's actually a really popular technical tool that's used by traders to help them identify trend direction and to time their entries. So what the indicator is doing is it's measuring the difference between a longer term and shorter term moving average to classify price as being either bullish or bearish. So you can see the indicator here. The indicator is this histogram with a red line running through it. So essentially, when the histogram is below the center line, so when the bars are down here, that means that the market is classed as bearish and likely to continue to sell off. And then obviously when the histogram is above the center line, this means that the market is bullish and likely to continue higher. So the indicator can be used in a few ways. You can use the indicator as a trend direction guide. So for example, if you open your chart and you want to know if the euro is bullish or bearish, you could simply pull up the MACD indicator and take a look at where the histogram is. And then if the histogram is above the center line, you can think, right, the euro is bullish today, so I'm only going to look for long entries. Or you could look at it and think, right, the histogram is below the zero line, the market is bearish today, I'm only going to look for short entries. So this is one way to use the indicator, using it as a guide, as a reference point. The other way you can use the indicator is to actually use the specific crossing of the center line as a signal, because this is often used by traders as a signal, a specific signal to actually enter the market. So when the histogram crosses above the center line, that's a signal to buy. When the histogram crosses below the center line, that is a signal to sell. Now the indicator also measures momentum, and that's shown by the size of the bars. So the bigger the bars, the more momentum in the market, and the smaller the bars, the more the momentum is waning. However, unlike the RSI and the stochastics, you'll notice that there is no upper or lower threshold. So those indicators are typically referred to as bound oscillators because they have an upper and a lower bound. However, the MACD doesn't have an upper or lower limit. It isn't bound. It doesn't really signal that the market is overbought or oversold. It's really just giving you an idea of the trend direction and the strength of the trend. Now, let's take a look then at an example of how we can use this fantastic indicator in our day trading. So first of all, just looking at this image, you can see clearly how effective the MACD tool can be for highlighting the direction of the trend in the market, but also helping you identify the best points for entry. So you can see that I've marked on the charts in horizontal lines. The red lines show when the MACD gives a bearish signal, and the green lines show when the MACD gives a bullish signal. So without any further information, just by looking at this image, you can clearly see how effective the MACD tool can be for capturing these moves and for giving us an idea about the trend. So if you look at this first signal here, you can see the price sells off, we get a bearish MACD signal, and then we get this large run to the downside before the indicator switches and starts to move higher. And then at this point here, you can see that the market gives a bullish signal. So the histogram moves above the center line, we get our bullish signal, and price takes off, and we get this massive run to the top side, a really big move, before again we top out, we start to move a bit lower, reverse lower, and then at this point here you can see we actually get a bearish signal. So at this point here, the histogram crosses below the center line, we get a signal to sell, and then look, we get the same magnitude of move. We get a move almost all the way back down to the start of that bullish move. So we've caught two huge runs here before once again we get a bit of a double bottom here. The market switches and starts to trade higher, and then at this point here you can see that the indicator crosses to the top side, giving us a bullish signal. And from this point here you can see that we get another run to the top side, a little bit smaller, but still this is a great run. You know, if you caught this, you'd be very pleased indeed. So we get a good run to the top side here before we stall out at this resistance. We get a nice little triple top, and then we sell off and reverse lower. We reverse down to this point here where we get a bearish signal with the histogram crossing to the downside and the red line. So just looking at that chart, as I say, without any further information on price, you can clearly see that there is big opportunity with this indicator for capturing moves and for gaining entry to the market. Now, as I said earlier, the great thing about this indicator is that it has quite a few uses. So as I was saying, to begin with, you can use the indicator as a directional cue. So for example, if you are a breakout trader, so let's say that your strategy is you look to buy price as it breaks above highs when the market is trending higher, or sell price as it breaks down below lows when the market is trending lower. So the MACD can be a really fantastic guide to help you get a sense of which direction you should be looking to trade. So let's say you open up this chart, you pull it up, you're right here at this point, you can see that the indicator is bullish, it's above the center line. So this means that for this day, you're only going to be focusing on bullish setups. So you'll be looking to buy price as it breaks out above highs, and you'll continue with this strategy until the histogram reverses, and then at which point you'll look at the chart and say, right, the MACD indicator is telling me that the market is bearish today. And so for that day's trading, you'll only be looking to take bearish breakdowns. You'll only be looking to sell price as it breaks down through lows. So this is a really fantastic way and a really stress-free way of helping you identify trend direction, because one of the things that I know a lot of new traders struggle with sometimes is identifying the trend direction. So this can be a really easy, stress-free way for you to identify the trend direction and tell you how long you should be staying in the trend. Okay, so once the market is moving in a bullish fashion and you've entered a couple of buying trades, it will tell you at what point you should be looking to reverse your bias and to trade to the downside and vice versa. So this is a really great way to use the indicator as a reference, as a guide. So you're using the indicator to give you some direction, but you're not actually trading the indicator as such. Now, the next way that you can use the indicator is to actually trade the signals. So as you can see on this chart then, I've highlighted the areas where the MACD crosses either above or below the center line. And these can be fantastic signals for entry points. And again, a really stress-free way of helping you trade the market. However, if you decide to go down this route, there is something that you need to bear in mind, and this is something that I always highlight whenever I'm talking about trading signal to signal, whether it's moving averages, MACD, stochastics, whatever it is. If you're going to trade signal to signal, you need to bear in mind that there are a lot of times when the indicator gives back a lot of profit. Okay, so look at this point, for example. We get our bearish signal on this candle. Okay, we get a large run to the downside, a really good amount of profit there. However, if we're simply waiting to close our trade out or reverse it at the next bullish signal, you can see that by the time the next bullish signal occurs, we've almost come all the way back up to where we got in shorts. We've given back all of that profit. Okay, and the same is true here. We get this bullish signal here, we're long, we get a really nice run to the top side, market reverses, we're waiting to exit the next bearish signal, which doesn't occur till all the way down here. So we give back around 2/3 of that profit. Now, of course, there are times when you catch a really big, smooth run like this. However, you'll have to find this out with your own study, but for the most part, there are a lot of periods where the indicator gives back profit in this type of fashion. So the way in which you can counter this then is simply by being a bit more mechanical with how you manage the trade. So instead of looking to hold the position open until a counter signal develops, you can simply look to target 2 or 3 times your risk. Okay, so from the point you enter, you need to determine a stop loss value, which will either be fixed, such as every stop is 50 pips or 75 pips, depending on the volatility of the instrument. Or you could use a candle basis. So where you enter short, you could think, right, my stop will be behind the candle I entry on. So it would be a 2 candle stop. And then if you were long, your stop would be below the candle you got in on. Okay, so you could use 2 candles. However way you do it, essentially what you need to do is determine your risk on the trade, to determine your stop loss value, and then simply look to capture 2 or 3 times that risk. So typically what this will mean is that you end up avoiding a lot of these situations where you give back these good amounts of profit. However, you will occasionally miss capturing the big runs that occur from signal to signal. So this is something for you to determine based on your own chart study how best to operate. But that is one way of countering the downside to the MACD indicator, which is its tendency in choppier markets to give back profits. But as I say, it's a fantastic indicator for giving these signals and for capturing the trend. And you can see just based on this chart alone, the way that it is able to capture these moves. So it really just comes down to you in terms of how you can develop a system around the indicator. But it really is a fantastic one to use for day trading. Now, the final way that you can use the indicator then is to trade the crossing of the signal line and the MACD. And I know that someone's just mentioned this in the chat actually. So the signal line then is this red line running through the histogram, and essentially what it is a moving average of the difference between that longer term and shorter term moving averages, which create the MACD histogram. And if this all sounds a little bit confusing and complicated, don't worry, because essentially all you need to know is that for a bullish trade, you simply wait for the MACD to be bullish like it is here, and then you wait for the MACD to cross down below the signal line and then cross back above it. Okay, so the MACD needs to be above the center line, and this means that the trend is bullish. We then wait for the histogram to cross below the red line and then cross back above it, and this gives us our bullish signal. And then to the downside, then we simply wait for the MACD to be bearish, so the histogram needs to be below the center line. We then wait for the histogram to pop back above the signal line and cross back down below it, and this gives us our bearish entry point. So this is another really popular way that a lot of traders use the MACD indicator, and the great thing about this is that it probably appeals to the conservative traders a bit more because we're waiting for an extra filter with our trades. So instead of just crossing as the histogram crosses the center line, what we're doing is waiting for the signal line and the MACD to cross. So we're waiting for that added confirmation, and you'll find that this works particularly well in trending markets to give you a number of entries which allows you to add and compound your moves. So this is one that works particularly well as the market is trending. So that's the MACD indicator. I hope that you found that interesting and useful, because as I say, it's actually one of my favorite indicators for day trading. So I hope you're looking forward to playing around with that after the webinar. Okay, so let's move on then and look at the last of our day trading indicators, which is the Parabolic SAR, stop and reverse indicator. And this is another indicator which is a really fantastic tool to use in day trading. And it's another momentum indicator. You can see it here, which the indicator basically shows up as these green dots on the chart. And the indicator essentially highlights where the market would need to move to confirm a reversal. So essentially, what the indicator is telling you is, while price is moving higher and there are green dots below price, this means that the market is expected to continue to trade higher, and the price would need to come down below one of these green dots to confirm a bearish reversal. Similarly, if the green dots are above price, this means that the market is moving lower and is expected to continue to move lower, and price would need to come above one of these green dots to confirm a bullish reversal. So it really is a fantastic indicator, and it's so useful that it actually plots it on the chart for you, because it's telling you where price needs to go to confirm a reversal. So it's really useful not just for highlighting reversals and capturing entry points, but also for working out where to put your stops. Okay, so let's take a look then at an example of how we can use this fantastic indicator. Just bear with me for 1 second, just 1 second. I just need to stop the recording. Okay, apologies for that. Can I just check that everyone can hear the audio and see the screen clearly before I carry on? Great. Okay, so looking at an example of how we can use this indicator. So as I said, essentially what we need to remember with the indicator is that where price is moving to the downside and the dots are above the price action, this means that price is expected to continue to move to the downside, and price would need to move above one of these dots to confirm a bullish reversal. So you can see here just how well this works. So we have price moving to the top side here. The dots are coming up underneath price, showing that the market is expected to continue to rise. And then at this point here, you can see that the market actually breaks down. We get a reversal lower, price comes down below this dot, and then you can see that we get the switch, okay? So this would be our entry point here when we get this switch. So the indicator flips bearish. You can see that the dot changes from being below the indicator to above, from being below price action to above price action. And this tells us that the market has reversed. So we've got a bearish reversal in play. And so we simply get short as price continues to break down. And the great thing about this indicator is that because of the location of the switch, it gives you a really natural location to place your stops. So where the where price has reversed from this high point and we flip short at this point here, we can simply put our stop above the high. And then again to the downside here, where we get the switch higher, we simply put our stop below the low. So because the reversal is always occurring in this fashion, we always have a really natural location to put our stop. So it's really handy for this. Now you can see just how well this indicator tends to capture movements in price action. So you can see that we get long trending periods where the dots stay on one side of the market. And this is why that the indicator has become a really fantastic trader favorite for trailing stops. Because as you can see, we know that the momentum has to shift to the extent where price moves above one of these dots to confirm a reversal. So let's say that we're short from this signal here and the market is selling off. We know that price has to shift above one of these dots to confirm a bullish reversal. So in terms of how we trail our stop, we have an inbuilt mechanism for trailing our stop. We can simply trail our stop down behind these dots because we know that until these dots are broken, the bearish trend is likely to continue. So this is a really fantastic indicator, not just for taking trades and capturing reversals, but actually for helping us trail our stops. And this alone will improve your trading, because I know from a lot of the new traders that I work with that trailing stops and understanding how to move stops and manage a trade as it's open is one of the big traps that they fall into, one of the big hurdles that they face. So what you should find from using this indicator, if you're a trader who struggles with stop placement and especially with managing open trades, you should find that this indicator really helps you stay in your trades for longer. Now the beauty, Vincent's just asked, what is the best time frame for all four indicators? I mean, it really depends what your trading style is, Vincent, because the great thing about these indicators is that they work on all time frames. Now obviously, if you're a day trader and you're operating on the 1 hour charts or the 15-minute charts, then these indicators are going to have a much shorter reference period, but they work just as well if you're a swing trader. So you can trade them on the 4 hour charts and the daily charts. And a lot of swing traders rather, do trade these indicators on the daily charts just as successfully as day traders trade them on the short term. So I guess that's one of the big benefits to using these indicators, is that it really does they work on all time frames. So it really does just come down to which time frame you like to trade on. Okay, so we've looked at a few really great indicators here. Now obviously we've only looked at the indicators individually, and using indicators on a standalone basis traded with price action is a really simple, powerful way to approach the market. But of course, you can also combine indicators to create trading strategies which have more filters. So in terms of combining indicators then, two of the indicators which work particularly well together are the Stochastics indicator and the MACD indicator. So we know that the MACD indicator can be a really great tool for helping us identify trend direction, and we know that the Stochastics indicator is really useful for highlighting periods of overstretched momentum. So how might these two indicators work best together then? Well, the best way to use the MACD indicator is to use it to highlight the trend. Okay, so this tells us which direction we want to be trading in. So if the MACD is above the center line and bullish, then we want to look to buy. However, we want to wait for periods when the market is correcting within the bullish trend and momentum becomes oversold, because as we know, this means that a reversal higher is likely. Now similarly, if the MACD is below the center line and bearish, then we want to sell. But again, we want to wait for periods where the market corrects against the trend and momentum becomes overbought, because we know that there is a chance or a likelihood that a reversal lower is going to happen. So let's take a look at an example then, and I'll talk through this in a bit more detail. Okay, so the first thing we do then when we come to the market, open our chart, pull up our two indicators, MACD and Stochastic. You can see them both here, the MACD above, the Stochastic below. And what we want to do first of all is look to the MACD indicator to establish our trend direction. So we can see from this point here, which I've highlighted with the red horizontal line, the MACD has crossed to the downside. So the histogram is below the center line, And this tells us that the market is bearish and likely to continue to the downside. So once we've established that the trend direction is bearish, we know that we want to look for selling opportunities. And so this is where we look to the stochastics, because what we want to identify are periods when the market corrects higher against itself and momentum becomes overbought and overstretched, because then we know that a reversal lower is likely to happen. So if we track the indicators then from the point that the MACD flips, we can see the MACD indicator flips bearish here. Market continues to sell off. We get this trade to the downside. You can see the indicator flips into oversold territory here. So the trend is really starting to strengthen. You can see the histogram bars are starting to get bigger. However, at this point here, you can see we get a small correction higher, just like we saw at this point. So the market's selling off. We've got a bearish trend as shown by the MACD. But we've got this small correction to the top side. However, you can see that at this point here, we get the stochastics indicator moving into overbought territory. So what's going on at this point then is essentially this. The market is in a bearish trend. So the dominant trend is to the downside, but we're experiencing a short-term correction against the trend. However, at this point here, the short-term correction has become overextended and momentum has become overbought. So when we see that occur, we know that we've got a really good opportunity to enter a short trade and capture the trend as it resumes, which you can see is what happens here. So as those indicator lines cross, which we talked about in the stochastic section, which is a really fantastic way of gaining entry to the market, you can see that price sells off again and the trend continues to the downside. And then interestingly, look what happens. We get another setup over here. So the market is still in a bearish trend. The MACD indicator is still to the downside, telling us that we should be looking for selling opportunities. But then at this point here, we get a small correction higher again, just like we did here. The stochastics indicator registers overbought momentum, and then once again we get that opportunity to sell when the stochastics lines cross. Okay, so you can see what we're doing here is really simple and straightforward. We're basically using a two-tiered system where we look to the MACD indicator to identify the trend direction, and then we look to the stochastics indicator to actually time our entries and gain a specific entry point. So this is a really great way to approach the markets because it's a solid, methodical approach. And the great thing about this is that because the entry relies on two signals, so the indicators need to align, you'll often find that for the most part, you'll be able to avoid a lot of the false signals that occur during choppy markets if you were just using one of these indicators by themselves. Because the market has to make quite a strong move to let the indicators align, okay? So when the MACD is bearish, you're not looking to buy when the indicator is oversold. You're only looking to sell when it's overbought. And similarly, if the MACD is bullish, you're only looking to buy when the stochastics is oversold. You're not looking to sell when it's overbought. So waiting for these two indicators align, you'll often find will keep you out of a lot of unnecessary losing trades and help you catch some really fantastic trades in trending markets, which should really bring a boost to your day trading. So this is a really fantastic system you can use. It's a fantastic method. And again, as I said, it's a brilliant way of combining indicators to identify trend direction and then gain specific entry points to the markets. Okay, everyone, so I hope you've enjoyed today's session and are looking forward to testing out these indicators in your own day trading. And remember, the key to successful indicator trading really is in developing clear, well-defined systems for entry, which include criteria for not taking trades, because you don't simply want to take every signal that pops up. You always want to be considering the location, the market conditions, and the risk reward. Sorry, so I've got a question there. Yeah, the time frames for these indicators, Vincent, you can really use them on all time frames. It just depends what your personal preference is. A lot of swing traders use them on the daily time frames just as successfully as day traders use them on the 1 hour time frames and 15-minute time frames. You know, and another great way to use them is to use some multi-time frame analysis. So highlighting the indicator signal on a higher time frame and then dropping down to your execution time frame to pick up confluent signals. But yeah, for the most part, the signals work really well on all time frames. Obviously, the lower down you go down the time frames, the more sensitive they are to price action and the more signals you're going to be, as the markets are a lot more noisy. So you just need to bear that in mind. Okay, so before we wrap up, are there any more questions I can answer for you? Brilliant. Okay, well, I'm glad that you all enjoyed that session and found it useful. And I hope you're looking forward to getting into your day trading indicator, study on the charts, and I look forward to catching up with you all next time. In the meantime, take care. Thanks a lot, everyone. Cheers.